Welcome back to Radio Rothbard. I'm Ryan McMaken, executive editor with the Mises Institute. And with me today is our Henry Hazlitt Research Fellow here at the Mises Institute, Jonathan Newman. Now, Jonathan's one of our in-house economists, and I'm bringing him on because I want to talk about some real basics about economics, sound economics. But it has a real effect on your daily life. It has an effect on the interest rates you pay on things like mortgages and on credit cards and on anything, really, where you might take out a loan. And this all relates back, in many cases, to current U.S. fiscal policy and monetary policy. The U.S. government and its central bank are engaging in a variety of policies that affect how you are able to afford basic things like shelter, like consumer loans, and how does that work? How do these mechanisms work? And I feel like there's not much explanation out there in terms of how the government's runaway spending policies come back to really rip you off and affect you in your daily life. And a lot of people think that the government's huge deficits really have no effect on that. They look back at the previous 30 years and think, hey, the government's been running huge deficits for a long time. Doesn't matter. They just keep doing it. It won't affect me. The fact is that it does have an effect, and I think we'll look a little bit at how that does affect you in terms of interest rates. So, Jonathan, thank you for joining me today. And I think really to start off right, we have to talk a little bit about how interest rates get set in the larger marketplace. Without getting I don't want to go into like the very basics of it in terms of economic theory, but just looking at how investors and the people who buy and sell bonds and debt affect interest rates. And I think looking at the larger market for debt and how that affects interest rates helps us get a better handle on this impression that many people have that the Federal Reserve sets the interest rate, right? And you can see how people would come to that impression, because there's a lot of talk about how, well, the Federal Reserve has set or has targeted and has decided interest rates should go up, or has decided that interest rates go down. So people connect then Federal Reserve policy with the interest rate. Now, of course, the Fed affects interest rates, but when we look at the broader market, what should we look for to really kind of see what is going to set the direction that interest rates are moving in, right? Because even though the Fed has a significant amount of influence here, I mean, the debt markets are huge, and interest rates are really heavily affected by these people out there who are investing in debt. And I just want to throw it to you then to maybe tell us how we should think about it in terms of, okay, who is out there and what institutions out there are really the deciding factors in what interest rates are in the larger world.
Well, you're very right to point out that the Fed does not have complete control over interest rates. So you're right that there's, especially when they have some sort of meeting on the horizon, or they just had a meeting, there'll be lots of journalists talking about how the Fed just decided that interest rates would be X, or they just decided that there would be a 25 basis point decrease, or whatever the change was. And they just sort of say it in this sort of blanket sort of way, that almost like the Fed is this price setting institution, and they just decide on what the interest rates are going to be throughout the economy. But of course, that's not true. In fact, one thing that makes that plainly true is the fact that a lot of the rates at which you would borrow are not the same thing as the federal funds rate, that's the rate that those journalists are referring to, and that's the rate that the Fed targets. So the federal funds rate is the rate that banks pay each other for reserves. And so when banks are trying to decide how much they want to keep in reserves, years ago they would have a minimum reserve requirement. Nowadays they keep reserves for different reasons, but the point is they want to keep a certain amount of reserves. If at the end of the business day they don't have enough, then they would go to their friend banks, go to their peer banks to borrow that money. And so the rate that they would pay on that is the federal funds rate. And so it's a very it's a very low rate because it's overnight. It's very secure. Your banks are confident that their fellow banks will be able to pay it back the next day. But that's the rate that the Federal Reserve is targeting. And so whenever you see those pronouncements, that's very specifically what they're talking about, is that one particular rate called the Fed funds rate. Now, there are other important interest rates. Like, a lot of people are interested in their, like, what mortgage rates are, especially if they're interested in buying or selling a house. Credit card rates, auto loan rates, student loan rates. And the way that we should think about those rates, if you go look at Mises and Human Action, you'll get a slightly different presentation of how we should think about interest rates. And Mises would say it's the ratio of prices, present prices versus future prices. And so that's what is determining, or that's how you should think about what the interest rate is. It's not a particular price. But, for casual thinking, if you just want to think about it in an easy sort of way, you can think about it in terms of just plain supply and demand, and the interest rate is the price that emerges there. And so for each one of those different sorts of interest rates, it means that you have some people supplying present money, and you have people demanding present money. So you can draw a supply curve, you can draw a demand curve, and then the interest rate that they decide on that would clear the market between the borrower and the lender is the interest rate. And so that is an easy way to think about what causes all of the different changes in these different rates. So why would interest rates go up or down? And so you can think about it in terms of supply and demand. So perhaps there's a big decrease in the one particular interest rate, and you could think about that if you have reason to believe that there is a big increase in supply or a decrease in demand or something like that. Then that would help you explain what's moving that. Now, you mentioned the influence that the federal government at large, not just the Federal Reserve, has. Of course, the federal government is a huge supplier of debt. So, like, they spend a lot, and they don't collect enough in taxes to finance all of that spending. And so whenever that sort of thing happens, which is all of the time, it means that they have to issue bonds. They have to borrow from the public. And of course, they understand that many of those bonds will later be sold to the Federal Reserve, and the Fed can buy it with brand new money. And so that introduces a whole host of factors that change people's inflation expectations. People think about stock market bubbles and whether they will collapse, and so people are thinking about the risk of these different assets. But that's just sort of like a general bird's eye view of some of the different institutions and things that are determining interest rates, like you asked.
So, I mean, just to illustrate that point, right? So, is it correct to say that if there are a lot of people who have a lot of savings and cash available, and they're willing to loan it out, in those cases, wouldn't interest rates be low then, because there's just a lot of money out there, and then if you want to loan it out, you're going to have to be willing to accept people paying lower interest on that, right? Or else nobody's going to borrow your money. And then the opposite is true, whereas if people are short on cash, but there's a lot of people who want to borrow money, interest rates are going to be high. Is that generally the case?
Yeah. And so that's what I was referring to before, is you could sort of think about it in a supply and demand sort of sense, that there's a lot of people supplying something and not see if we get this straight, and not a lot of people demanding it, then you'd have a low price. If you have the opposite sort of situation, then you'd have a high price. And that's why I also mentioned some of the big players, like the Fed is a huge buyer, they're a huge demander of government debt. And of course, the federal government is a huge supplier of government debt. And so these institutions, of course, they're outside the market, but what it means, if they, in their actions, they are influencing the sorts of decisions and the sorts of loan contracts that people in the private market economy will accept. So, like, for example, if I can earn a guaranteed 5% by lending to Uncle Sam, then that's going to change the sorts of other investment activity and lending activity that I would do in the private market economy. So that's the sort of crowding out effect that people sometimes talk about, that to the extent that the government borrows, then it's taking money and it's taking real resources away from what could be profitably invested in the private market economy.
So we do hear often that people assign a value, that is a qualitative value of sorts, to interest rates being high or low, right? It seems that the general working assumption is that it's good when interest rates are low. And so when the Fed intervenes to push down interest rates to lower levels, that's a good thing, and that's what the Fed should be doing. Are low interest rates the goal? Do we know we're in a better society if interest rates are lower, or does it depend on the situation? I mean, I know historically, if we look at overall interest rates, they have gone down over time. So does that mean good, that we're more civilized now because interest rates are lower? I mean, how should we think about that? Is high or low a good or bad thing, or does it just depend?
That's one of the most unfortunate memes, if we can use that term, in financial journalism, is that low interest rates are good and the idea is that they're stimulating a bunch of spending. They're making it more attractive for people to go out and spend and borrow. And then they view higher interest rates as like this. It's like stepping on the brakes for the economy. So higher interest rates are bad because it inhibits how much people will rack up credit card debt, or it inhibits somebody on the margin, their willingness to go out and buy a home because like their mortgage rate that they would be able to get is too high. But of course that totally misses the point. For one very basic reason is that's arguing from a price change, which is a big no-no in economics. You're not allowed to make those sorts of conclusions just by a change in price. So think about how you would apply that same sort of reasoning to the price of any other good. So step away from loans and just think about, I don't know, like apples at some produce stand. Is it good that the price of apples is high? Is it good that the price of apples is low? Suppose you're comparing it to what it has been before. And of course, like you can't really, that's like asking the wrong question. Well, the point of prices is to clear markets. Like the point of price changes is because there's been some sort of change in market conditions that made it so that the way that we will best economize the use of apples is for that price change to occur. And so you could say the same thing about loans. You could say the same thing about credit. Or maybe I should say you can't say that same sort of thing when it comes to loans and credit. And the reason why is because you have to think about like what is causing the change in the interest rate. And of course, one of the big offerings of the Austrian school is Austrian business cycle theory, which explains that if interest rates are pushed artificially low, so if you print up new money and it enters the economy through credit markets, that will increase the supply of loanable money. But what you're doing is you're pushing the interest rate below what would have happened if there was no intervention in that market. And so there's all sorts of consequences that result from that. One very important consequence is the fact that entrepreneurs will now pursue different lines of production. So you'll change the sorts of decisions that are made by consumers and by producers. They'll pursue lines of production that aren't feasible. They can't be completed because there's not enough real savings there to back it up. And that's something that that is not a problem if you have an unhampered credit market. So there's always this nice balance between the supply of savings, the demand for present money, and you get this nice balance between what real resources have been set aside so that these longer production projects, these more capital intensive production projects can be completed. And the interest rate sort of represents that balance between those two. But if you're messing with it, if you're manipulating and pushing it down, then you cause all of these other sorts of problems that result in the business cycle.
I mean, do you think it's related to this idea, the idea that interest rates should be always low is related to this idea that we think that the economy only grows when there's a lot of spending, that a spending-based economy is the good kind of economy rather than an economy based on, say, saving and a capital accumulation? Because that seems to be where we are. Every time I hear about what's good for the economy, it's always focused on spending and people buying more consumer goods, more retail. And is that really the case? I mean, it would seem that, right, that if you're building a good foundation for the economy, there would be a lot of saving and investment going on rather than just people buying stuff.
Did you ask this because I just wrote an article on it?
I think that may be related.
Yeah, yeah, that's a great point. So from the policymaker's perspective, either on the fiscal side or the monetary side, if you're in a recession, any sort of economic slump, their goal is to stimulate spending. And so they can do that through some direct mechanisms and through some indirect mechanisms. So like one thing that the government can do directly is they can just increase spending. Since the government can engage in all sorts of deficit spending, and they don't have the same sort of discipline that companies in the private market economy have, it's okay for them to run up very, very large deficits even when business is bad, even when the economy's in the dumps. And so their goal there is we'll just spend, and this spending will go out into the economy, and it will provide this sort of multiplier effect because we're increasing people's incomes. Those incomes can now be used to increase spending on consumption and investment and so on and so forth. So we can stimulate the economy by boosting spending. And then in the indirect sort of way, that's the view that monetary policy has. So we can push down interest rates, we can increase the supply of loanable funds, and the goal of that is to do the same sort of thing: stimulate spending, make it cheaper for people to borrow and spend, whether that's credit cards, so that there can be more consumption spending, or business loans where businesses will now take that new easy money, they call it easy money, and employ people, buy factors of production, expand their business that way. But the goal, when they're doing both of those, either the expansionary fiscal or monetary policy, the goal, as you said, is to stimulate spending, is to just get the numbers to go back to where they were before. And that's because there's a couple reasons. One reason is they're just looking at the aggregate spending levels, and they saw that, hey, now we're in this depression or this recession and spending is going down, so maybe we can fix it by getting spending to go up. So they're just looking at the data and they see, well, hey, this number is going down, let's try to do things to get the number to go back up. But also, if you look at the Keynesian way of looking at the economy, the way that they model the economy, either through the circular flow model or the Keynesian cross, or even average supply and aggregate demand, what they're doing, going back to the circular flow models, they're viewing the economy through this two-agent model, where there's households on one side and firms on the other. And the way that you put them together is they interact in two different markets. They interact in a market for factors of production. So households sell their labor and capital goods and raw materials to the firms, and then the firms take those things and they convert it into final goods and services to sell to the households. And so you get this, that's why it's called the circular flow. You get this flow of spending where money is going this way and then this way. And so the way that the Keynesian framework thinks about resurrecting an economy that's in the dumps is you've got to kickstart that spending again. You've got to get people buying things and selling things again, because and of course from the Keynesian perspective, there's nothing inside the market economy that can do that, and so that's why they advocate for both fiscal and monetary policy to do that for them. And sorry, this is sort of a longer response, but you're getting me to talk about this article that I wrote. Of course, that's a terrible way of looking at the economy. The economy is not flows of spending. There's a great insight from William H. Hutt. You should go check out the quote that I put in the article. And Hutt explains very clearly that spending is a result. Spending is a passive outcome. It's a passive result of the exchanges that are occurring in the economy. So what happens first is people have values, and they survey the goods that they have. They look at the goods that other people have and are selling, and then those two people meet and they decide, yes, there is a double coincidence of wants, or no, there isn't a double coincidence of wants. They haggle. They might come to a price at which they can exchange money for property. and then they actually go through with the exchange. And only at that point do you see, or can you calculate spending for that one transaction. And so if you just add all of that up, what you're adding up is what was the result of all of these different transactions. But the meat of the analysis, what's actually going on before you can calculate spending, is people have values, people have plans, people have property, they have skills, they have all these different things that are important to their exchanges that they have with other people in the economy. And so the way that Rothbard proposed that we should think about the economy as opposed to a circle is we should think about it as a lattice work. So you've got all these interconnected nodes, you've got all these people that are exchanging with one another, and people have like long-term plans, people have short-term plans, you've got entrepreneurs who are trying to guess what consumers will want in the future, and so they have to purchase factors of production today. So there's this balance between what's going to happen later and what's going to happen, and what I need to do now to make sure that does happen in the future. And so it's all of these interconnections. It's a very complex network of exchanges, and those exchanges are determined by people's values and the prices that they settle on. So you should start with values and prices. That should be the center of your analysis of how an economy is functioning, and not abstract flows of spending, especially not aggregate spending.
Well, that's not the impression I get from reading articles about Fed policy at Bloomberg. Basically, it's we want interest rates to be low so that number go up at the stock market, right? I mean, that's the basic brand, and has been really since the early 90s at least, maybe even the late 80s, certainly with Greenspan coming on board. In the very late 80s. And in fact, now, since 40 years ago was the mid 80s, we've really moved to a point where the Fed has been obsessed with low interest rates and with really keeping the dollar from getting too valuable. People forget that even though Volcker has this reputation as being a high interest rate guy and a real hard money guy, Volcker was fully on board with the Plaza Accords back in the mid and late 1980s, which was designed specifically to devalue the dollar compared to other currencies. And part of that was low interest rate policy. And so looking at, that's a slightly different issue, though. But I think what we can say is that in recent decades, the Fed is obsessed with keeping interest rates low. And as you hinted at, right, the reason they're doing that is they're looking at these aggregate numbers in the economy, and they're saying, hey, there's not enough spending. These aggregate numbers that indicate economic growth aren't going up fast enough, or they don't look as robust as we prefer. So let's push down interest rates, and that'll make the economy be better somehow. And that certainly seems to be what's been the case in recent months too, right? The Fed became afraid of the political effects of price inflation. Price inflation was hitting 40-year highs in 2022. And 2023, early 2023. So they thought, okay, we are forced by political realities to allow interest rates to go up in order to maybe bring down price inflation a little bit. And a lot of people think, oh, the Fed they're data driven. They care about how the economy functions. I would deny that. I don't think the Fed cares about economic fundamentals. It's a political organization that's designed to address political problems. High price inflation was a political problem. So they had to let interest rates go up. They allowed them to go up, all right? I wouldn't say that they set interest rates higher. They intervened less in the marketplace, and this allowed interest rates to rise. That helped to stabilize the inflation rate a little bit, bring down rates of increase a little bit. But it seemed that in September, the Fed had decided that inflation had decreased enough that they could then pivot to other political goals. Now, depending on who you talk to, the political goal in September was just to rev up the economy so that Kamala would get reelected, that the Biden faction of the ruling class would get reelected. Maybe that was true. However, certainly something that we can be pretty darn sure of is that the Fed felt that it wanted to get economic numbers going up again. For whatever the political reason, the more narrow electoral reason might have been, politically they were interested in making the economy look better again, which the Fed has been doing almost nonstop since 2008, obsessed with low interest rates. No matter how many times they tell us the economy's great, they stuck to very low interest rate policy. That seemed to be going on in September. The Fed comes back and says, oh, the economy's great, the economy's fine, the economy's strong. Oh, by the way, we're going to start intervening to force down interest rates again because we want the economy just to be a little bit stronger. And so the economy, it seems, that could never be quite strong enough that the Fed doesn't think that low interest rate policy is at least a pretty good idea. So in September, then, the Fed intervened. They gave us this big jumbo cut to the target interest rate of 50 basis points. Now, historically, they only do that when the Fed sees something wrong with the economy, because every time the Fed over the last 30 years has cut the target interest rate by that much, there's a recession, 7, 8, 9 months later. So they fear something is bad with the economy. Okay, let's cut the interest rate to get those numbers going back up again. So they did that in September, and then they pushed down the interest rate again in November by 25 basis points, and then again in December. Yet a strange thing has been happening. Even though they've been pushing down the target policy rate, longer term interest rates have been going up anyway. So, one could say that Fed policy has been to try to push down interest rates, and yet when we look at yields, that is the interest rate on, say, 10-year, on 30-year, I think even on the 7-year, the interest rates have actually been going up. What does that tell us about the Fed? Is it possible that the Fed is somehow becoming less powerful here? Is the market not believing the Fed when it says that it's going to get interest rates back down? What are some of the reasons why you might see some of these interest rates go up in spite of Fed policy trying to push them back down?
It's a great question. I think the simplest answer is they're not convinced that the Fed can keep inflation down. I think investors are anticipating a continuation of expanded budget deficits from the federal government, and so they're expecting that the government is going to need to borrow a lot and increase spending a lot in the future, and so I think investors are pricing in this a decreased purchasing power of the dollar in the future, and of course that's going to influence what interest rates they'll accept today. Because they're expecting money will be worth less in the future, and so I think that's probably the simplest explanation. I mean, you talk with different investors, they'll give you a slightly different version, but I think that's the general view, is that this investor class, the bond buying class, is not convinced that inflation has been beat. They are not convinced that the Fed can get inflation down to 2%. What's interesting is you were talking about the history of recent interest rate changes. The Fed started decreasing interest rates before they hit their 2% target. You know, the golden inflation rate. They target this 2% inflation, and so what Powell said in some of his press conferences after the FOMC met is, he said, we have to jump the gun a little bit. We can't start normalizing, so to speak, interest rates after we get there. We have to, jump the gun a little bit so that we're not just responding to what happens in the moment, but we're ready for what happens when it does. So I think there's a lack of confidence that the Fed will be able to get back down to 2%. And if you look at other data on inflation expectations, I was just looking at it before before we recorded, in none of the horizons, in the specific measure that I was looking at from the Cleveland Fed, in none of the measures for none of the horizons did any of those inflation expectations charts actually get down to 2%. So it sort of dips down a little bit, but then it increases into the longer term. And so I think that's probably the best explanation, is that people are not confident that the Fed can control inflation. People are not confident that Trump and whoever becomes president after Trump can actually pay off debt or have budget surpluses. There's no anticipation of a balanced budget, no anticipation of a decrease in government spending, and so for all those reasons, they're pricing in the fact that they have those expectations that the dollar will have a lower purchasing power in the future, which means they need a higher nominal return when they're making those loan contracts today.
Well, and you keep hearing a lot from the president, from people who claim to care about government spending and decreasing it, that somehow inflation is related to deficit spending. And so we have to get down government spending. And man, it's a challenge to explain this because there's so many steps in the process of how this works. But when I look out there and I see that interest rates, especially longer-term interest rates, aren't going down in spite of the Fed's efforts and its announcements, and you say they're not confident that inflation is going to go down, how is government spending related to that? Because if it would be one thing if government spending was just, taxes come in and then government spending goes out. And I think one could argue that that wouldn't be inflationary in the broader sense. But we live in a country where we're looking at, in the upcoming year, this fiscal year we're now in, we're looking at least a $3 trillion deficit. And that means, right? That means $3 trillion of new debt, new treasuries, has to go out the door into the marketplace. And the government's going to have to find people to buy all of those treasuries, right? So, I mean, we're back to the supply and demand issue that you talked about before, where you've got a lot of people offering to sell debt, and you've got some people who are willing to buy it and who have who want to buy that, and then you're going to have to pay interest rates on that. But that's such a huge amount of new debt every year piling up on top of the previous year. That isn't that a reason why investors would expect interest rates to go up also? Because they're looking out there and they're seeing just huge amounts of new debt entering the marketplace. So they're thinking, well, gee, yields are going to have to go up because there's so much more debt out there in coming years? Or am I getting that wrong?
No, I think you're right. I think people are expecting larger deficits, a much larger pile of debt as well. Of course, that's basically saying the same thing. Every time you have a deficit, you're adding to the pile of debt. But you mentioned this relationship between government spending, deficit spending, and inflation, and it's a really important thing to understand. Government spending by itself is not inflationary. Deficit spending by itself is not necessarily inflationary. The only way that we get inflation is when the Fed is increasing the money supply. And the way that the Fed increases the money supply to a large extent is by purchasing government debt. So they purchase debt from the primary dealers, and when they purchase it, they're buying it with brand new money. And so that's the way that the money supply increases. And of course, as good Austrians, that's how we think about and define inflation, is that it's an increase in the money supply. But even if you take the more mainstream view that inflation is an increase in prices, the only way that you can get this systematic, economy-wide increase in prices is when there's an increase in people's ability to purchase goods on the market. And the only way that that can happen generally is that there's an increase in the money supply, keeping other things constant. So you talked about the case where the government taxes more. There's a great little section in Mises's book, Economic Policy Thoughts for Today and Tomorrow, where he talks about two different scenarios. One where the government decides to build a hospital, and they finance the construction of the hospital with taxes. So they increase taxes, and then they use the tax money that they collect to purchase the materials that are needed and the labor that's needed to construct the hospital. And Mises says, well, there would be some distortions, obviously, because you're substituting, the government is demanding goods and services as opposed to the people who originally held that money. And so there would be changes in prices, but there wouldn't be any necessary change in the general price levels. Of course, Mises would never use that term, but we wouldn't see prices in general rise. And as a result of that, because the money was taken out of the economy first, and then it was reintroduced by the government when they were constructing the hospital. But then Mises contrasts that scenario where you're funding it with taxes with the case where the government decides, taxes are unpopular, people don't like to see a big increase in how much is taken out of their paycheck, and so we'll just print up the money to finance the construction of the hospital. And so Mises says when that happens, it means that the government is now competing with everybody else in the market who have the same ability to purchase goods and services. So now the government is outbidding other people in the market for those goods and services. And there wasn't a corresponding decrease in the ability to purchase those goods and services. And so what you do see is of course, through the Cantillon effect, through this rippling out, you see prices in general start to rise. And that's because there was an introduction of new ability to demand goods and services on the part of the money printing that was used to finance the construction of the hospital. So Mises points out those two. Now, people are aware that those are not the only two ways that the government can finance its spending. It can also borrow. And the issue there is there's two different. We can put the people who purchase government debt into two different categories. There's the Fed and everybody else. And so if the Fed is the one that's purchasing government debt, then that's the same thing as financing the construction of the hospital with brand new money, because you're increasing the supply of money, and that money, through the primary dealers and the government finally receiving those funds. Actually, they receive the funds when they first borrow. But the point is that there's the introduction of new ability to purchase goods and services as a result of that method. However, if private citizens or financial institutions, if they're the ones who are purchasing the government debt, it means that they actually have to sacrifice. They have to part with money to purchase the debt. And so that deficit spending is not inflationary, to use casual language. So if the Fed is involved, you get inflation. If the Fed is not involved, there's no inflation. To go back to how I started talking about this, government spending by itself is not inflationary because it depends on where the money is coming from. If it comes from taxes or from private individuals purchasing the debt, then there's an offset. But if the Fed is the one who ends up purchasing the debt, then it's inflationary.
So I think the final question then is why would the Fed purchase that debt? And I think that's the final stage, right, of how government spending leads to inflation, and also related to the issue of why the Fed wants to keep interest rates low. So we've got all these different pieces coming together, right? We know the Fed likes to keep interest rates low. It likes to keep spending up. But another reason it likes to keep interest rates low, and this is why government spending is going to increasingly become a problem for regular people, is that the government has to pay interest on all this debt that it's putting out. So as we just noted, right, just this year, the Fed is going to flood the world with $3 trillion in new debt. Okay, well, that's going to, in the marketplace, in a functioning market, that would cause interest rates to go up, because now you're asking people to buy up $3 trillion in new debt. So, wouldn't that send interest rates really, really high, and then the federal government would have to pay interest, just like you do when you have a mortgage, right? You got to pay, in addition to whatever principal you're paying, you got to pay interest. But that's a political problem, because now as the government has to pay more and more interest, that leaves the government with less and less to spend on politically popular stuff like Social Security and wars and all of those other things that the government does to buy votes and to just curry favor with various pressure groups. And you can also then end up in a serious sovereign debt crisis situation where you're paying so much interest on your debt that it starts to make it difficult for you to even pay your debts at all, and to borrow more, and to really just keep the lights on at the government. And we see this happens historically to lots of countries. So the Fed, it seems, has an interest then in keeping interest rates low for two different reasons. It's not just to get the economy going and humming along and get those aggregate numbers up, but it looks to me like the Fed is also involved in buying up federal debt to keep those interest rates from getting out of hand in terms of what the federal government has to pay on those interest rates. So the Fed is actively buying up some of this debt, is it not, in order to keep interest rates from going up? And by that, I mean in order to keep the federal government from having to pay higher and higher levels of interest on the debt that it keeps cranking out. So when we are talking about Fed interest rate policy, we can't just look at the one motivation, which is to keep the aggregate economic numbers looking good. But also there's this internal problem, right, where they want to make sure that the interest rate doesn't get out of hand, if you will, in terms of what the federal government has to pay on these trillions and trillions of new treasuries that it has to force out into the market. So is that something else that we need to pay attention to as well when we're looking at the Fed's interest rate policy?
I think you're absolutely right. One thing that I would add is that there's sort of a catch-22 because you're right that when the Fed purchases government debt with new money, that does help to push interest rates down, at least temporarily, right? At least in the short run. But as we know that as you increase the money supply, you make it possible for people to bid up prices generally in the economy. And so if people start to expect larger deficits and they expect that the Federal Reserve will purchase much of that government debt, that's what's informing the investors' inflation expectations that I was talking about before. And so you get this strange result where the Fed is pushing down interest rates by purchasing government debt, but you're also fueling inflation expectations over the longer term, which causes investors to demand higher nominal interest rates going forward. And so I think that's probably the more likely outcome. So a lot of people talk about federal government default or sovereign debt crisis, but I think that's the more likely or more that's the situation that would arise first, is that the Fed would literally be in this spot, and the Treasury as well, where there's nothing else that they can do, because the more that they print to purchase the government debt, the more they fuel inflation expectations, and then you start this process where people stop using the dollar, perhaps. I'm not making any commitments on like a time frame here, but that's how that would play out.
So is it safe to say then, if you're just a regular person, you're looking at this next year of $3 trillion, and next year and the year after that, let's say Trump manages to cut $500 billion from spending, which would be quite a feat, but you're still then looking at $2.75 trillion new deficits. So it's going to pile on even more. And all else being equal, then that's going to fuel more long-term increases in the interest rate. And it's going, and of course, mortgage rates are tied to the 10-year yield. That's going to drive up interest rates on homes. It's going to drive up what you're paying on your credit card yields, right? Because this is overall one market in terms of debt, and so different types of debt are affected by increases in interest rates elsewhere. So can we say that if someone came to me and said, why should I care about federal deficits? How do they affect me? Because they haven't had any effect in the past. Can we say that after 30 years of massive debt increases that we have finally reached the point where it seems that we're finally backed into a corner so that we can choose two paths, where basically what you can deal with is as the federal government cranks out more debt, then you can face higher interest rates, or you can face just outright price inflation as the Fed intervenes to force down interest rates. Or maybe you even get both. You get both rising price inflation and rising interest rates on long-term debt. Can we point to those things and say, yeah, if you're wondering why interest rates are high, if you're wondering why price inflation is increasing, you can blame a lot of that on the huge federal deficits. And it's not really this fantasy land anymore where we can just pretend that deficit spending has no effect on our daily lives anymore. And I think we were able to create that impression for a while, thanks to lots of global issues related to disinflation and other lesser economies where they were buying up tons of U.S. treasuries and so on, which was helping keep the interest rate low, right? But it seems that maybe those days are over, and so now we're having to pay the piper in terms of massive national debts and annual deficits. And so if I'm wondering, gee, why can't I afford a house with interest rates so high? Or, gee, why are grocery prices going up and it's really pinching me in terms of my home budget? Can we look to federal deficits and say, yeah, that's part of the problem. You need to decrease these deficits in federal spending, and that would actually make your cost of living improve.
Yeah, you're exactly right. So the main goal should be to decrease spending. A lot of people sort of equate Austrians with being deficit hawks, and of course there is a lot of overlap. But really, from the Austrian economic perspective, where the waste of resources happens, it's with the original decision to spend. And so whenever the government is spending, it means that it's taking over a larger share of the resources that we have here. And so, of course, like if you're trying to buy a house, if you are taking on debt to go to school, if you want to buy a car on credit, all of these sorts of things, as we've shown throughout this episode, a lot of it has to do with the fact that there are these big players that are making it either more expensive to borrow, or they're making it less expensive to borrow. And in both of those cases, there are all of these unintended and longer term consequences that cause more problems going on into the future. So I think you're absolutely right. Now, you mentioned these two different paths that we can go down. I'll just mention, I'm very pessimistic. I don't see two paths. I see a very, very narrow path, perhaps, and then there's this path that we're on, which is increasing deficits, increasing monetary inflation. It would take somebody like Andrew Jackson, basically, to come in and turn this ship around. In the Fed, huge cuts to government spending. I don't see that in Trump. I'm slightly optimistic on some fronts, but generally not optimistic about the subject that we're talking about now, which is the total size of government spending. So that's my view on that.
Yes, unfortunately, I have to agree. It's not that everything's getting worse, but when we're talking about fiscal policy and we're talking about monetary inflation, I see no diversion from our current path until you reach some sort of significant financial crisis, sovereign debt crisis, Soviet-style devaluation of the currency. And many countries have been down this path before, and there would be nothing unique about it for the United States to do it. But lots of things have occurred in the world that have managed to allow us to prolong it out into the future. But I don't know how much longer that situation can go on. Now, of course, like you, I'm not willing to say, 18 months from now or 2 years from now. But the long term, right? Keynes says, in the long term, everybody is dead. Well, I mean, spoken like a guy with no descendants, right? A childless guy who, for him, I guess the long term is when you're dead. But for me, right, I have children and hopefully grandchildren someday. So even if the long term is 50 years from now, that affects me. That affects things I care about. And boy, 50 years is an eternity in terms of government finance. And man, if you're just if you're looking for what is a time frame to be pessimistic about, well, I would say you don't even have to go out 50 years to look at where you've got just unmanageable runaway federal deficits and built-in massive amounts of monetary inflation that is being used to deal with this runaway debt. And that seems to be the very likely future. And because of the mechanisms that we've just talked about. So in the future, I think we're just going to have to keep returning to this issue again and again. What does deficit spending, what do these massive federal debts have to do with rising prices, with rising interest rates? And I think it's just going to become more and more salient as time goes on. So thank you for joining me today, Jonathan. I really appreciate your explanations of these things. And I think it's going to sound highly technical to a lot of people, but I think unfortunately it's just going to be increasingly in our face in terms of what the impacts are on our daily lives in the near future. So thank you all for listening to Radio Rothbard. We'll be back next time with more. So we'll see you then. One more thing, Radio Rothbard listeners, I want to make sure you know about our event coming up on February 22nd. That's Saturday. It's in Tampa, Florida. That is our Educating for Liberty conference. This is our conference discussing the realities of education in America today. How the state has a stranglehold on education from kindergarten to postgraduate programs, and how we need to do something different if we're going to educate for freedom, if we're going to counter the state narratives that are now so common. To do that, we're bringing in some of our top scholars. We got Tom DiLorenzo, our own president. We've got Jonathan Newman, our Henry Hazlitt Research Fellow. We've got Jason Jewell, Chief Academic Officer of the Florida University System, and several others will be covering this topic in some detail. Tickets are $70 for Mises members, $75 for non-members. You can get a discount, 10% off the discount price, if you enter Rothbard25 as your promo code. You go to Mises.org/Tampa25. That's MISES.org/Tampa25 and enter Rothbard25.